Hello, everyone, and welcome back to the Deep Dive. I hope you're having a fantastic week and are ready to tackle one of the most compelling yet valuationally challenging businesses in the entire medical technology space. Today, we are undertaking a comprehensive financial dissection of the structural heart giant, Edwards Lifesciences, trading under the ticker EVOQE. This company is a certified pioneer, responsible for fundamentally shifting how we treat devastating heart conditions. But the core question we have to resolve is not really about the quality of their execution, which is, arguably world-class. It's about the price. Edwards Lifesciences has these incredible, enduring economic advantages, gross margins consistently above 70%. But does the quality of the business, its impenetrable market position, and its aggressive pipeline into TMTT truly justify the premium valuation? Or is the market already pricing in, well, decades of flawless future growth? That is the analytical mission of this deep dive.
That is precisely the challenge, because investing in Edwards forces you to confront that central philosophy of growth compounding. Can extraordinary quality overcome an extraordinary price? It's a multi-billion-dollar dilemma. And before we dive into the anatomy of that moat and pipeline, just a quick note for everyone joining us.
For those of you who want to translate these investment ideas into actionable trades, having a professional-grade platform that can handle complex order types and detailed research is really non-negotiable. We rely heavily on interactive brokers, and we've partnered with them to get our viewers a stock bonus when they sign up and fund a new account. It's a substantial benefit.
So they get a tangible financial benefit and support the channel at the same time. That link is in the description below, right?
That's absolutely correct. And of course, if you find value in this kind of in-depth, rigorous discussion, the kind that goes multiple layers deeper than the headline, the single best way to ensure you catch the next deep dive is to subscribe and click that like button. It truly helps us prioritize the content you want to see. And if you have any questions about Edwards, please jump into the comments section.
Perfect. Now let's get into the heart of the matter. Pun intended. Pillar number 1, the structural heart fortress. Let's start with the business model.
Okay, let's unpack this business model because a proof of its quality is, well, it's baked right into its simplicity. Edwards focuses almost exclusively on two areas: structural heart disease and critical care monitoring.
Right. But let's be clear.
Yeah.
The massive engine driving almost all of their economic power is TAVR, Transcatheter Aortic Valve Replacement.
You hit the nail on the head. TAVR is a minimally invasive procedure. It replaces a diseased aortic valve, usually due to severe aortic stenosis, without open heart surgery.
And it addresses a truly life-threatening condition. The business model is, I think, remarkably elegant. They sell these proprietary, incredibly high-value medical devices.
The valve itself, the delivery systems, all of it.
All of it. They sell them directly to hospitals and specialized clinics all over the world.
And this is where we see the financial proof, right? Those jaw-dropping gross margins. Year in and year out, you look at their income statements, and Edwards consistently reports gross margins above 70%. I mean, their 5-year average is closer to 75%.
That kind of profitability, you usually only see that in what, software? Or luxury goods, maybe.
Exactly.
That level of profit is a signal of a few things converging. You have the IP, specialized manufacturing, and critically, the inelastic nature of the medical need.
It's not a discretionary procedure.
Not at all. It is a life-saving necessity. And that gives Edwards significant pricing power in a category they essentially created.
So the model itself, addressing this critical need with the best, least invasive tech, it feels like it's built to last for decades.
For many decades, I think. And the structural trends supporting it are just, well, they're irreversible.
First is just demographics. Global population is aging.
Right.
And age-related diseases like aortic stenosis are naturally, inexorably increasing as a result.
But the second trend is the huge technological and behavioral shift in medicine.
You mean the move away from open heart surgery?
An irreversible, powerful shift away from the trauma and risk of open heart surgery toward these transcatheter procedures like TAVR. And we're just at the beginning of that shift, accelerating into the next waves.
TMTT, the mitral and tricuspid interventions.
Exactly. That forms a deep, decade-long tailwind for their entire portfolio.
And we can't overlook the human factor. The desire to live longer with a higher quality of life. Demand for this is completely inelastic.
It's non-discretionary. And as the technology matures and guidelines evolve, to treat asymptomatic patients earlier, the total addressable market just gets bigger.
This is not a cyclical business. It's tied to human mortality.
Now, let's move from the business model to the structure that protects those 70+% margins, the economic moat.
This is the core reason it deserves that premium valuation.
And we define that primary advantage as a combination of intangible assets, so patents and clinical data coupled with extremely high switching costs.
The intangible assets are where it starts. It's not just a few patents, it's a whole patent thicket around the device design.
And decades of pioneering work. I mean, they were the progenitor of the technology with the Sapien platform.
That history gave them a huge head start in accumulating clinical trial data. Years of proven patient outcomes that no competitor can just replicate overnight.
Which leads directly to the regulatory hurdles. And these are maybe the highest barrier to entry you can imagine.
We aren't talking about a simple clearance.
No, we are talking about pre-market approvals, PMAs, that require billion-dollar, decade-long pivotal clinical trials.
And those processes, plus the patent protection around new generations like Sapien 3 and 4, they just repel new competition. It keeps the market as a duopoly, really.
But the truly fascinating part of the moat, for me, is the high switching costs in practice.
Which are more operational than financial.
Right, exactly. You have to remember the steep learning curve for these cardiologists and their teams. These procedures, while minimally invasive, are technically complex.
Very precise.
Extremely precise.
Yeah.
So physicians and entire hospital teams, they become highly proficient in one specific system. Let's say the Edwards balloon expandable platform.
And the hospital standardizes everything around that. Procurement, training, inventory.
And the switching cost is that enormous investment in retraining and the perceived risk of moving to an unfamiliar system.
Unless a competitor can offer something significantly superior, which is incredibly difficult given the data, the inertia is just too powerful.
When a life is on the line, familiarity and trust in the brand are the ultimate switching costs.
We can even see it in the technology. Edwards' Sapien is balloon expandable. Medtronic's core valve is self-expanding.
Different approaches for different patient anatomies. A team would need dedicated training in both systems to use them effectively. And, well, few hospitals want to bear that full cost.
Not when one trusted platform serves most of their patients.
So Edwards leverages this deep clinical evidence and brand trust to maintain superior pricing power. They sell a premium product because the clinical community sees it as the gold standard.
And the moat isn't static. It's actively widening.
That's the key. They aren't resting on their laurels. They're systematically taking those TAVR profits and aggressively funding R&D for the next category, TMTT.
Spending over $1 billion a year on it.
Which reinforces their leadership and makes the moat broader and deeper at the same time.
To really internalize the quality here, we need to apply some mental models. And Edwards Lifesciences perfectly embodies the Tollbridge analogy.
That's the perfect description. They effectively own the mandatory toll road for treating a major category of heart disease.
When a patient needs an aortic valve intervention, the payer Medicare, insurers, has to pay the toll.
Which is the proprietary high-margin TAVR device. And the demand for that passage, for the life-saving procedure, is completely inelastic.
And we have to connect that to the reimbursement dynamics in the U.S. The certainty of Medicare reimbursement sets a floor under the price.
Which guarantees the hospital's willingness to pay the premium for the valve. It makes that high gross margin incredibly reliable.
There's also a psychological bias at play here. First conclusion biases within the physician community.
In high-stakes scenarios, cardiologists stick with what they learned first and what they trust. They are not incentivized to experiment.
Not when the established platform has decades of stellar outcomes.
And if we look at customer sentiment, it's overwhelmingly positive. The patient sees TAVR as revolutionary, life-extending, better quality of life.
And the professional customer, the hospital, the physician, shows incredible commitment. Edwards maintains a dominant market share despite high-quality competition.
The rapid adoption of new valve generations is the strongest evidence of that commitment. It shows a culture focused on innovation, which secures loyalty.
Okay, we can't discuss a fortress without acknowledging the armies trying to breach the walls. Medtronic and Boston Scientific.
Medtronic is the most significant rival with its core valve platform. They use their huge global scale. But that diversification is also a double-edged sword for them.
Exactly. For Medtronic, TAVR is just one segment of a sprawling enterprise. Edwards is a pure-play structural heart specialist.
And that singular focus allows for a deeper commitment, faster R&D cycles, and tighter clinical partnerships in this one specific area. Focus matters.
Then you have Boston Scientific. They're trying to expand into structural heart, mostly through M&A.
Right, buying their way in rather than pioneering.
And their challenge against Edwards is monumental because of the sheer weight of Edwards' clinical data and brand trust.
They have to prove that their new systems are not just comparable, but demonstrably superior over a 5 to 10-year span to overcome that physician inertia.
And that's a high bar, especially since valve durability, a long-term data point, is now critically important.
We have to pivot now to management, because even a wonderful business can be ruined by poor capital allocation.
We saw that big transition in 2023. Bernard Zovighian took over from Michael Musselman as CEO.
And the market saw this as pretty seamless. Zovighian comes from within the structural heart division.
Right, and his philosophy is clear: long-term, patient-centric innovation with a heavy emphasis on TMTT. It's an owner-oriented message.
That's critical. But let's play devil's advocate for a second. Musselman was synonymous with the TAVR revolution. A new captain always raises a minor flag, right?
Sure, there's always some new management risk. Analysts were watching to see if the TMTT pipeline would face delays.
But so far, Zovighian has only reinforced that aggressive R&D focus, which is reassuring.
And that focus is reflected in the incentives. Compensation is heavily weighted towards performance-based stock and options.
So their personal wealth is tied to long-term value creation. The alignment with shareholders is structurally sound.
If we look at the capital allocation track record, it's highly rational, which is what you want in a compounder.
Priority number one, the highest returning thing they can do, is reinvestment in R&D.
They consistently put a huge portion of their cash flow, over $1 billion annually, something like 18% of revenue, right back into R&D. It's the lifeblood of the company.
Priority number two is strategic M&A. And this is usually smaller scale, focused technology buys. They're buying capabilities, not just revenue.
And finally, shareholder returns. Crucially, Edwards does not pay a dividend.
Which would be an inefficient use of capital given their internal opportunities.
Instead, they aggressively use share buybacks. It's the most tax-efficient way to return that excess free cash flow to long-term shareholders.
The takeaway is simple. Management operates like true owner-operators.
Let's ground this in the financials. The foundation of this fortress is the consistency of its profitability, anchored by those gross margins in the 70s.
Now, we should acknowledge that near-term operating margins have narrowed a little bit recently.
But that's not a failure of the business model.
No, it's a reflection of inflation, supply chain pressures, and most importantly, the choice to invest heavily in TMTT infrastructure right now.
It's a high-quality problem to have.
The most essential metric here is return on invested capital, or ROIC. Historically, Edwards has consistently delivered ROIC in the mid to high teens, often over 20%.
That sustained, superior ROIC is the proof of a wonderful business. It means they create substantial economic value from every dollar they deploy.
Absolutely. The average medtech company struggles to stay in the double digits.
Next, look at their free cash flow conversion. It's very strong. The net income flows effectively into operating cash.
Which tells us they run a healthy, asset-light, high-margin model. They aren't tying up tons of capital in plants or working capital.
And finally, the balance sheet. It's a textbook fortress. The debt position is minimal. They often have a net cash position.
This financial strength gives them incredible optionality. They can fund their R&D and buybacks without needing credit markets. They are masters of their own destiny.
Okay, we have established this is a wonderful business. Now, the pivot point, the valuation. The risk is almost entirely in the price you pay.
Edwards Lifesciences commands a persistent premium valuation. You'll often see PE ratios in the mid to high 30s.
And during periods of peak enthusiasm, they can easily push 40 or even 50 times forward earnings.
The market's rationale for this premium is sound. It's a high-growth compounder in a non-cyclical market. The earnings stream has a bond-like quality to it.
But the danger is the high price hurdle. The quality is already priced in. If you buy at 40 times earnings and the company executes perfectly, say 15% annual earnings growth,
your stock returns will still likely be constrained over the next few years because of the inevitable multiple compression.
you might see that 40x multiple shrink back toward a long-term average of 30x. That 25% shrinkage is a mathematical drag on your return.
That is the fundamental risk of overpaying for perfection.
So how do we find a margin of safety in a company that will likely never look cheap on traditional metrics?
For Edwards, the margin of safety isn't in a cheap PE. It's in the certainty of future growth, combined with a temporary disconnect in the price.
So you're betting on the long-term cash flow certainty, but you're buying it during a moment of market irrationality.
Right. We see two practical scenarios where that happens. Scenario one, a deep market-wide panic. Think 2008 or the peak of the 2020 sell-off.
A non-company specific correction that drags all high-quality names down with it.
Exactly. Scenario two is often more accessible, a company-specific temporary setback.
Like a minor clinical trial disappointment that doesn't affect the core tech.
Or a regulatory delay that just impacts next quarter's guidance. Or even a supply chain glitch that temporarily hits margins.
Short-term, recoverable issues that incite immediate negative sentiment, allowing a patient investor to buy the wonderful business without paying for perfection.
Okay, so assuming the price is right, what are the primary growth engines?
The first is the continuing expansion of TAVR indications. The biggest catalyst here is moving into treating asymptomatic patients.
Patients who have severe aortic stenosis but haven't developed debilitating symptoms yet.
This is a massive shift. Successfully moving into that pool could instantly unlock a much larger segment of the addressable population.
It could potentially double the number of eligible patients. If those trials prove the benefits of early intervention, the TAVR market just accelerates dramatically.
But the truly exponential opportunity is in TMTT, Transcatheter Mitral and Tricuspid therapies.
This is not incremental growth. This is the next multi-billion-dollar market.
TMTT is the second wave, and Edwards is positioning itself as the leader with platforms like EVOQE and Pascal.
Unlike the aortic valve, the mitral and tricuspid valves are anatomically far more complex. They require multiple different approaches.
Successfully getting approval and reimbursement for EVOQE and Pascal is critical. These platforms could replicate the TAVR success story over the next decade.
Now, we have to balance this with the permanent impairment risks, the non-recoverable dangers.
Risk number one is the black swan, technological obsolescence. A competitor develops a fundamentally superior, non-infringing game changer.
It's a moderate risk given the complexity, but the impact would be catastrophic.
Risk number two is a damaging clinical failure, a major product recall, or worse, a long-term trial showing durability issues with a new valve.
Eroding the trust of physicians and regulators is a death sentence in this sector.
Okay, focusing on the near term, what are the upside triggers for the stock?
Well, the primary triggers are TMTT clinical milestones. We are looking for definitive, successful trial readouts and then FDA approval for platforms like EVOQE.
That's the moment the market shifts from pricing and optionality to pricing and certainty for the next growth engine.
The second major catalyst is regulatory, specifically CMS NCD expansion.
National Coverage Determination. This is the ruling by Medicare that dictates which procedures are covered.
And this matters so much because TVR patients are typically older, making Medicare the dominant payer.
So clinical approval is only half the battle. Reimbursement coverage is the other half.
When that NCD expands to cover, say, asymptomatic patients, U.S. market access just accelerates dramatically.
These catalysts effectively validate the capital allocation strategy, which markets love to price in immediately.
Okay, let's consolidate everything into a clear investment thesis, starting with the bull case, the reasons to own Edwards.
Core conviction 1, irreversible secular growth. Structural heart disease is massive, growing, and undertreated.
Core conviction 2, the impregnable economic moat. Intangible assets, clinical data, regulatory hurdles, all leading to superior ROIC.
Core conviction 3, exceptional capital allocation. Rational management, prioritizing R&D, and using aggressive buybacks.
And core conviction 4, future growth optionality. TMTT is a certain second multi-billion-dollar wave of growth.
Now the bear case, the primary risks.
Risk number 1 is overwhelming valuation risk. There is zero room for error. Future returns are highly sensitive to multiple compression.
Risk number 2, pipeline or competitive failure. TMTT adoption could be slower or more complex than TVR, or a competitor finally launches a superior product.
And finally, regulatory and macro headwinds. Delays in approvals, adverse changes to reimbursement, or persistent inflation could depress near-term earnings.
So when we talk about second-level thinking, we need to ask what the market is failing to price correctly today.
The consensus is accurate but superficial. EW is a premium, high-quality medtech stock. They see the strength, but are wary of the valuation and the R&D spend.
Our analysis leans toward a more contrarian view. The market is currently underestimating the size and certainty of the TMTT opportunity.
The consensus sees Edwards as a TAVR company spending heavily to keep its lead. We argue it's transitioning into a structural heart platform leader.
A company capable of dominating not just one, but several complex valve markets.
And if that's correct, then the current high R&D spend isn't a risk. It's a high-return, compulsory investment to secure profits in the next decade's wave.
That perspective makes the premium justifiable if you have a long-term horizon.
Now, let's perform the critical red team challenge. Invert the bull case and look for the failure scenario.
The ultimate risk is this. The current high price has fully discounted the success of both TAVR expansion and TMTT. The company is trapped on an innovation treadmill,
Where its high R&D reinvestment just consumed its naturally high ROIC. You're running hard, but your returns stay flat because of the multiple you paid.
If that expected 15% plus annual earnings growth fails to materialize, maybe TMTT adoption is just slower, the premium valuation will collapse.
The disaster isn't the business dissolving. The disaster is the resulting multiple contraction.
If the PE shrinks from 40x down to 25x over 5 years, that drag alone could wipe out all the underlying earnings growth.
And the wonderful company becomes a poor investment, delivering flat or negative returns simply because the price paid today left zero margin for error.
To synthesize our deep dive, the quality of the business, the strength of its moat, the resilience of its financials, and the discipline of its management are all, well, they're undeniable.
The challenge, as is often the case, lies solely in the entry price. The long-term upside depends almost entirely on the successful exponential adoption of that TMTT platform.
Which brings us to our final provocative thought for you, the listener. Edwards Lifesciences forces investors to confront the core Munger-Buffett dilemma.
The choice between accepting a high price for the high certainty of a wonderful business today or waiting patiently for a temporary, non-permanent misfortune, a clinical hiccup, a political scare, to allow you to buy it cheaper.
What is your personal definition of a margin of safety when you're confronted with a truly exceptional, life-saving compounder?
A perpetually fascinating dilemma. Thank you for joining us for this analysis of Edwards Lifesciences. We hope this deep dive helps sharpen your own investment process.
Make sure to subscribe and hit that notification bell so you don't miss our next deep dive. We'll catch you next time.